So Darren, thanks for joining us again to go through some of the frequently asked questions that we get around taxation and property here at Your Property Financial. And really appreciate your time at Mansell & Co. Accountants to spare a few moments to go through some of these questions. One of the questions we often get around property is limited companies, and especially around buy-to-lets. So you've got a personal property in your own name and you rent that property out, or you buy a property and rent it out in a limited company. I just wonder if you could just give us a bit of an intro to kind of what is the difference between the two, and maybe why you would consider one other than the other.
Yeah. So obviously owning a property personally in your own name is what it is. It's your own property in your personal name. In the limited company, effectively that company owns the property rather than you personally. There's various reasons why you may want to go down either way, either structure. But what the government introduced about 4 or 5 years ago was how mortgage interest is taxed, or the tax relief on mortgage interest. And effectively now we're in a position where, if you own a buy-to-let in your own individual name, and you've got a mortgage on it, or you're paying mortgage interest on it, and you are a higher rate taxpayer, effectively you only get a sort of tax credit at 20% on the mortgage interest relief. So your marginal rate of tax could be 40%, but you're only getting a 20% tax credit on the mortgage interest.
Right.
Which has made it much more expensive in terms of tax exposure to have a buy-to-let property in your personal name. So that's where limited companies have come in much more prominently in the last 5 years, and a lot more people are doing it. Is because it's become quite expensive to have 1 or 2 buy-to-lets in your personal name in personal tax, whereas in a limited company structure, the property is owned by the limited company, but the mortgage interest is fully tax deductible, so you get corporation tax relief on it.
Right.
The way it works in the limited company is properties in the limited company, the property's rented out, so the limited company receives the rent, the mortgage is in the limited company name, mortgage interest is paid by the limited company, all the expenses go through, and you pay corporation tax on the profits at 25%. Which, if you're a higher rate taxpayer, 45% taxpayer is obviously slightly better, and effectively, you get the full tax relief for the mortgage interest as well compared to when you're in the personal name. So, in a nutshell, that's where it's come from.
Okay.
Now, you effectively, if you were to draw the money out of the limit, so the rental is out of the limited company, in theory, you would then have to pay personal tax on those drawings, either as a salary or a dividend, which again would be at your marginal rate of tax, could be 40%, 45%, or his dividend tax 33.75% and 38.75%. So that then could make it more expensive, but in theory, the limited company would have a director's loan, because obviously if you're buying a property in the limited company, you're going to have to put the money into the company for the deposit, which is probably come from personal funds. So effectively that's money you're owed back from the company, and you can effectively take that out, withdraw it as and when funds from the limited company, without any personal tax implications.
Right. Okay.
In terms, sorry, go on, Paul.
Well, no, I was going to say, so you've got the rental income coming in. So let's just call it, £1,000 a month comes in. Let's say your mortgage payment was £500, and therefore let's just assume no costs just for this conversation. So you then got £500 profit. It's then £500 profit at 25% corporation tax. We should say in the current tax year, taxes do change. Check with your accountant at the time. And then after that, whatever that number is, you've then got that as profit within the business. And if you bought a property and you personally put, 100,000 deposit down or 50,000 deposit down, that money is owed back to you because you personally invested in the business, as it were. You put that money in. So if there was a profit in the business, you could then withdraw that against the money you put in. Let's say that 50,000. So it'd be 50,000, take away the profit you'd made for that year. And there's essentially no tax implication to that because you're just taking money back out that you already put in.
Yeah, that's correct. Yeah, it's effectively a repayment of a part of that director's loan that you're owed from the business. So it doesn't need to be going down as any sort of salary or dividend payment, which would incur personal tax. So it's effectively a tax, basically a tax withdrawal without any tax implications.
Right. And then if you're, let's say you repaid all that director's loan, or I guess the other side is you could say, well, actually in the future, I want to move, I want to do this, that, and the other. Actually, I want to earn more. I want to declare a higher level of earnings. You could choose, and again, there's I guess the advantage of a limited company. You have options, whereas personal name, it's very much money comes in, money comes out. There's a tax bill, you pay it. Thank you very much. Whereas the limited company, you've got that choice to say, well, actually, I could reimburse my loan that I've put in, or actually, I want to declare a higher income. I'm going to take that money out, whether that be as a salary or a dividend. And again, there's charges to both and implications. So you could withdraw it as earnings, pay yourself a dividend, say 2,000-3,000 a year, and then essentially increase your taxable earnings for that year for, 2,000-3,000, whatever money you take out. That's an option, isn't it?
Yeah, that's correct. Yeah, you don't need to. It's not one way or it's got to be that way. It can be whatever. It suits the needs and where the business is at that point.
Right.
So yeah, if there's reserves in the company, profits in the company, and you want to take it out as a dividend, say, then that's possible, and you can. Then the director's loan sits there as well, and it doesn't disappear. That's there until it is repaid, basically. So.
And if you had a scenario where you had a couple and you've got, let's say, Mr. and Mrs., and you've got, let's say, Mrs. who's on a, £100,000 a year salary, she doesn't necessarily want to declare any more earnings because she's going to start losing her personal allowance potentially. And I guess that's another thing, isn't it? Above a certain level of income, you start losing your personal allowance. And again, within a limited company, you stop that extra income coming in, which you're only going to be taxed at quite a high amount. But let's say you've got the Mister who's he works from, looks after the kids at home or something, and he doesn't really have much earnings, or let's say he's a basic rate taxpayer or something. There is an angle there where you can potentially, if there is a profit, whether that be through salary or dividends, there's a way of paying the party who's going to be well within the basic rate tax band versus paying it to both parties, pushing one party further into the higher rate or additional rate tax band.
Yeah, that's correct. You could opt to pay a salary to the person with the lower income who's the basic rate or hasn't utilised their personal allowance, or you could do a dividend and Mrs. waives her right to the dividend and the Mr. takes his dividend. So that's an option as well.
And if there was
flexibility,
yeah, it's that flexibility, isn't it? And if you had that profit there, again, similar to like limited company trading, if you're a director of that or a shareholder of that, there are potentials to make pension contributions, which are effectively a cost. Is there an option within a limited company with property in it to make pension contributions to minimise the tax bill? Is that possible?
Yeah, so it's just got to be treated as earned income. There's potential to make a pension contribution, assuming the profits are there,
Right.
to make a pension contribution into your private pension through the company.
Right. So. Okay. And I know there's a piece that we've done on another one of our videos recently around the difference between a limited company and what we're actually referring to here, which is an SPV, a special purpose vehicle, and it's just that realization that interchangeably, and as we're talking now, we keep saying limited company, and it is a limited company, clearly, but it's a specific type of limited company, and I think that's really important to make clear, isn't it? It isn't. The ideal scenario is that a property is purchased within an SPV, special purpose vehicle. No, again, that's a tax kind of name or explanation for it. Sometimes I say special purpose vehicle. People think I'm talking about a Ford Mondeo or something. I'm not. It's a specific type of property, specific limited company which has property within it, versus let's say a trading company, for a local shop or something, and it's that differential, isn't it? And that's quite important from a tax point of view.
So that's vitally important. So as you say, a special purpose vehicle, it is there specifically for the intention to buy property in this case. Now, it can't do anything else other than buy investment properties, which is also very important for your purposes as well with mortgages and lenders.
Totally.
And effectively, you wouldn't want to, for example, let's say you had a trading company already, you wouldn't want to then buy an investment property in that trading company. Number one, because obviously an investment property is an asset, and a trading company has the potential for something to go wrong, and then potentially that asset is then vulnerable, if liable, you could come after the property. Secondly, you can tell me more about this, but lenders probably won't lend to trading companies for investment properties because of the risk with the trading company. So it is, and investment companies are taxed a corporation tax rate at a flat 25%. So that's what it is. Whereas a trading company is a slightly different tax rate. So it's vitally important that it's set up correctly with the right codes for the company's house codes to do with mortgages, to make sure that it states that it's a property investment company. And it can only do that as well. It can't diversify into anything else, basically.
Yeah, and I think that's where the SIC codes comes in. SIC codes comes in, and that's really the crux of it, isn't it? That's the kind of, if you like, the reference numbers or the ID for the company that is registered with HMRC, which defines what that company does, what it's involved with. So you don't just name something, property limited, and go, well, it's obviously property because it's got property in the title. It's not as simple as that. It's got to have the correct code registered with HMRC at Companies House, hasn't it?
Yeah, that's correct. So it's basically it says what the company does. In this instance, it's property investment, so it has to have that there. And yeah, HMRC want to see it. Companies has to be a company's house, and the lenders, when they're doing mortgages, will obviously want that to be correct as well. I believe, Paul, anyway, that has to be shown as the right ones. Otherwise, they can get
yeah. Different lenders have different requirements on the exact code required. And that's very important. And again, that's something that we discuss with a client as we're setting up. And, and obviously if we're working together, we'd say, tell Darren to be mindful of these are the codes we're looking at. Or tell, your accountant, this is what we're looking for. And as you said in your earlier point, lenders can, there is possibility of lending against a limited company. So, a trading company, it is possible technically. And there are lenders who can consider it, but they are few and far between. And again, the more complicated you make your situation, bear in mind it's not expensive to set up a company at Companies House, and of course you can support with that, Darren. So actually, a company freshly set up, because often I have clients say, well, actually, I've got an old company, I registered it, 7 years ago. I was going to do something else with it, and maybe I'm going to do this with it, and I did a bit of this, but I've not really used it in the last few years. And from a lender's point of view, you're asking a lender to lend to a company, but that company maybe has been there for a few years. They don't really know what were the liabilities, what were the company doing, is there something they don't know about? And lenders do like that kind of freshly set up limited company, which is registered as SPV, and then they know exactly what's going on. And like you say, if something goes wrong in the business, suddenly the property isn't an asset of that business, and at risk of being taken as part of a problem, that could come out. And that's exactly why the lenders don't like it. They don't want the property they're lending against to suddenly be on the line because of something going on with a trading company. So yeah, it's quite important to split that up. And of course, you could technically, couldn't you? You could have one limited company with, yes, just one property, and you could, in theory, have a limited company for every property you do. But in practice, a lot of the time, you'd have one limited company set up as an SPV, and you could have 3, 4, 5, 6 properties within that, couldn't you?
Yeah, that's correct. Yeah, you can have multiple properties in that investment property company.
Yeah,
hasn't got to be a new limited company or new SPV for each property. From a tax point of view, it makes sense just to add a tax and an admin side. It sort of makes sense to have one. I guess, again, coming back to your remit, really, the lending, occasionally, maybe there is a reason when lenders may want it separate. I'm not sure, you could probably, this might be your area, but generally speaking, from my point of view, tax point of view, company admin type point of view, there's no issue in having a property, SPV with multiple investment properties in it.
Yeah, I think it's very similar for lenders. Generally speaking, they don't mind. I guess something to be mindful of is once you become considered as a portfolio landlord, and there's specific regulation to define from the regulator around who that is and what that means. Generally speaking, then the whole portfolio then needs to undergo a stress test and a review to make sure. And this is again kind of wider stability in the financial kind of property market, to make sure that the portfolio can stand up if there's rental voids and issues, to make sure obviously wider implications for the country don't start having issues because of landlords doing something they shouldn't. But you've got a scenario there where some lenders will sometimes even say, we'll have your portfolio, we'll do the numbers and the stress tests in the background like this, but it's specific to that limited company. So depending on your property setup, the rental return you're getting in the yield, There are even scenarios where some lenders will say, look, potentially you want to have this property or these properties in a separate company, because when we can then just work the numbers out on that. Whereas if we got them all together, we're considering everything here. And obviously that's better arranged at the very beginning versus trying to transfer it or something or sell stuff in the future. But I guess coming back to the SPVs, one area where I think we have a lot of clients who come to us for support is when they've got a property, they're looking to move on, but they want to retain the current property and rent it out. And for the reasons you've mentioned there, no interest, only a 20% interest relief on the mortgage interest. And then you've got all the tax implications moving forward. A lot of people like to use that as an opportunity, don't they, to transfer or effectively purchase their old home into the limited company and then move on to the next home, and then retain that as a buy-to-let, but within the limited company structure.
Yeah, that's correct. So this, when it comes to owning it personally or through a limited company, I should just say that if limited company is really only if you're thinking about, i.e. you're a higher rate taxpayer, or you're going to buy multiple properties or plans to buy multiple properties. If you're a basic rate taxpayer, there's still no tax advantage to it. But let's say that the people that they're higher rate taxpayer, let's say they're 40% or 45% taxpayers, they want to retain their property, let it out, buy an onward residential. Now, if they were to do that in their personal names, I could obviously give some more detailed examples, obviously, if it comes up. But yeah, they'll have a significant personal tax liability if they were to rent this property out in their personal name, due to the fact that the taxable income is going to be about the mortgage interest added, deducted. And then they're only going to get a 20% tax credit off their tax bill for the mortgage interest. They could have significant personal tax liabilities, often where they may only be breaking even, or even potentially a loss once they pay the tax on it. Now, when they can move the property into the limited company, and as they are effectively selling it to the limited company, but as they are it's their main residence, they're selling their main home, so there's no capital gains tax on it. There's a stamp duty charge for moving into the limited company. But often, if there's enough equity in the house and whatever, they can potentially, obviously,
and lenders can lend that amount needed typically as well.
To cover it, they haven't got to find out of their own pocket. And then they've got it in a limited company, and they've also, at that point, they've gifted so effectively they're gifting the equity in the property. So they could have a couple £100,000 worth of equity in it, which is effectively they're gifted to the limited company, which forms part of their director's loan account. So they basically are owed £200,000 from the company at that point. And then they're getting the mortgage interest, corporation tax relief for the mortgage interest, and they're obviously got it in there. They can then draw down on that loan as and when, and they're paying tax at 25% compared to 45%, or worst case scenario, let's say they were earnings were 100 in the middle of 110,000 or something like that, where they're losing their personal allowance. So when you earn over £100,000, for every £2 you earn, you lose £1 of your personal allowance.
Right.
Which is a marginal rate of about 60% tax in that period, in that area. So so there's potential tax savings, and it's always good. So in all these scenarios, what I do with clients is we'll look at how much it's going to cost for them to do what they're looking to do, and then how much it would cost them in tax they kept it in their own name, as a limited company, and we'd look at how long it's going to take for them to get the initial cost back to make sure it's worthwhile. As I always say with these things, probably it's sort of a long-term game, rather than like if you're thinking in a couple of years I might want to sell the property anyway, there's no point doing all of this. But if you're thinking I want this for the next however many years, and hopefully it'll go up in value, and I just want to keep taking the rental income from it, then it potentially makes sense. But every case is different, and we will always sit down and look at every case in isolation and make sure that numbers stack up and it all works out. It may be that it doesn't. It may be better to keep it in personal, but in whatever way, we'll make sure that it's the most tax efficient way for the client.
Yeah, I think that's a really good point, isn't it? It's the as always with financial advice, what is your situation? And obviously in this video today, we're just talking quite generically around advantages, disadvantages, how it works. But an advantage to one person is not necessarily an advantage to another person, and it is that individual tax advice which is really important to get from a qualified tax advisor and accountant like yourself. I think the it's interesting, is it, when you think about how the tax is there in that scenario? You've got a let's say I'm in my home at the minute and I want to buy a new home, so I'm going to, if I keep the property in my personal name, and let's say there's, I don't know, I'm renting the property for £2,000 a month, it's 24,000 a year that's coming in rental income. A good chunk of that, I appreciate that you say there's the 20% credit, but a good chunk of that is going to form part of my personal taxable income. And if I'm, as you say, if I'm not earning any money, then I'm going to be well within the basic rate tax band, and personal allowances there and all that, and probably not much to worry about. If I'm earning 50 grand already, and then I have my rental income added in, suddenly I'm pushed into the higher rate tax band and all the implications that has. So it's but in the limited company, there's the money, that £2,000 a month comes in, you deduct all your costs, you offset the interest. Yes, you pay the corporation tax, but then it's then my choice, then, isn't it, then, to whether pay myself a salary or a dividend or potential director's loan reimbursements. There's that choice, isn't it, and control. So if I was on, let's say, 50 grand, I don't have to pay myself the profit from the business. Therefore, I could keep myself as a basic rate taxpayer and not go further into the higher X, and keep it there for the future or something, couldn't I?
Yeah, that's correct. It gives you that much more flexibility. The other thing, to, as you quite rightly point out there, is you could, let's say your earnings are £45,000 a year and you're in the basic rate of tax, and you think I've only got one property, I'm not making a huge amount of money from it, but because of the mortgage interest situation, because effectively your taxable income is before the mortgage interest is deducted. So let's say it's £1,000 a month, and you've got, say, £12,000 a month, £12,000 a year you're renting out. Your mortgage interest is 6, and you've got costs of 2,000 or something. So let's say you've actually made a £4,000 profit, but your taxable profit is 10,000. So then your taxable income for that year, your salary is 55,000, and you're then £5,000 into the 40% tax rate without you're really not, actually, because you've actually spent that money physically left your account to pay the mortgage interest. And before you know it, you've then got a 40% tax liability on some of that rent. And it becomes very expensive. So that's another thing, that this is what it's done, is it's pushed people into the next rate slightly. You could be I could be a 95,000 salary, and you think, well, okay, I've still got my personal allowance. Before you know it, you're 105, and you're losing some of your personal allowance. And so that's what it's done. It's made it very expensive for landlords and small time landlords, where you've got one or two properties where they're just doing a bit of an investment, and they're not trying to do it as an earning, like their main earnings or anything. But it's just become very expensive in tax, basically, and a bit of a minefield, really, to be honest with you, in tax as well for individuals.
Totally, and I think that's a really good point, isn't it? There's so many different variables to that. Whether it was previously your main residence, whether it was actually a buy-to-let. And again, there's examples here where it could be a buy-to-let in your personal name already, and then you're considering doing the transfer, and all the implications of that, whether it's personal tax, CGT, capital gains tax, we should say, and obviously income tax, and then stamp duty implications, and obviously in this transaction we're saying the word transfer, and that's kind of what you're doing. But be very clear, from a technical point of view, you are using the limited company to purchase the property.
Yeah, the limited company is buying the property from you personally. So that company then owns the property, and not the individual.
And that's very clear as well, because the purchasing event, very to be clear, that's what triggers a stamp duty tax liability. So you to transfer the property, you may think you're transferring in, and in a way you are, but because of that technical point of purchasing, there's then a stamp duty liability then to pay. So you don't just transfer your own home in and there's no tax to pay. There is stamp duty to transfer the property in most cases.
Yeah, that's correct. You've got the stamp duty. And then in another example, let's say it's an existing buy-to-let that you've had already, and you wanted to sell it to a limited company. Now, that would then be a capital gains event as well, and you would be liable, even though in reality the limited company's not giving you you're not receiving the cash for the property, you're not receiving any money, but you then have a significant capital gains tax liability, which is again means that a lot of people are in a position where they can have a property for 10-15 years, they can have a significant gain on it. They're not in a position to then pay that significant gain because they're not actually realizing it, if that makes sense. So there are occasional circumstances where it might be worthwhile to do an existing property, but again, it's all dependent on the situation and you know, lots of variables again. So, but it's something that we can look at and again, sit down and look at what the options are really.
Yeah, and I think that's a good point, isn't it? Again, it's just reinforcing it is there's always options, but there's normally a tax liability to those options.
Yeah.
And in addition to that, there are mortgage lender rules around those options. So, you know, you could do X, but then that has a mortgage lender saying, well, we're not happy for you to do that. And then you could have something where a mortgage lender says, yeah, we're happy for you to do that, but then there's a tax implication to doing it. So it's really important a lot of the time, isn't it? I find with the clients we talk about is to have an overlap of, okay, we're trying to find the best mortgage deal, the best way to structure this and all that. But at the same time, we just be conscious of, is that triggering a liability over here?
Yeah, definitely. And as you well know, we work closely together, and we will often have calls with clients together so that we can make sure we're all singing, you know, we've all got the client's best interest at heart, whether it works for your side, the mortgages, my side, the tax side, and
Sure.
and making sure that we got the best result all round for the client.
Yeah. Like you say, it's getting that advice, and you know, you mentioned earlier in the video that if you're looking to do something and it's short term, you know, fine. If you really want to do it, you can do it. But you know, there's potential a lot of implications in terms of costs from a taxation point of view. Certainly, a cost from a lending point of view, potentially in terms of, you know, early repayment charges that could be due, that kind of stuff. So it's something to go in with your eyes open and be aware of the timeframes. And actually, if it's, you know, generally speaking with property, if it's more of a long term approach, you know, generally these actions we've talked about today are probably a good idea. If you're buying a property in a limited company and you want to sell it in a year's time, you know, you can do that, but you're potentially just setting yourself up to a lot of costs. And as with all these things, you know, it's probably more of a long-term approach is a good idea. Just allowing for all the costs you incur with these types of transactions.
Yeah, definitely.
One thing I know that we've touched on very briefly is directors' loans. And I don't know if there was any kind of further thoughts around that you just wanted to share. And I know when we say directors' loans, we have loan director, how does it mean? And again, an example we've just given there, you know, I own a property now. I'm going to transfer it into the limited company. The limited company purchases it. There's a deposit within that, which I've essentially gifted to the limited company. So if I have a £200,000 property, I put that into a limited company and I have let's say a 50% mortgage on that. I've gifted 100,000 to the limited company. That is money owed back to me. So as profits generate in that business, I can start to reimburse that 100,000 potentially. Are there any other considerations with directors' loans we should be thinking about?
Yeah, so that is, yeah, you owe the money, but also obviously if you're, let's say it's just a normal loan, isn't it? If you're loaning that limited company £100,000 of your money, now it may be that you may want to think about charging interest on that loan. Again, with everything with HMRC, it's a bit more complicated than just a normal, we're going to charge it at 4 or 5%. It has to be done at sort of like a market rate. But also that interest is then taxable income for you individually. So depending on your other interest received and your other earnings and stuff, there may be personal tax due payable on that interest. The benefit is the company goes as a cost to the limited company, so you get corporation tax relief on it. But to add to it is because it's sort of a transaction with a director, you have to fill out a form called a CT61 with HMRC quarterly, informing HMRC of the interest charge, and HMRC then withhold a 20% tax that the company has to pay over. So there's a lot to weigh up there. With admin and stuff, it depends on the size of the loan. It depends on your personal circumstances whether you may want to do that. It's also, yeah, there's a few things to weigh up, but that's something to consider. Again, if money you want to, because in theory that £100,000, let's say not in that, in an example where you've literally put the deposit into the company to pay for the property, as £100,000 you could have. I know you're receiving the rental income, you're going to yield on it in the company, and you're going to get value. Hopefully, the property got up in value, but it's £100,000 you could have been putting somewhere else and receiving some form of interest. So, but it's a loan effectively. So, but it's all based on maybe your personal circumstances as well, because it may be that if you've already got interest elsewhere and you're 45% taxpayer, you probably don't want to pay 45% tax on a personal tax on money that's, you know,
Probably not.
Yeah, so it's something to consider anyway.
Sure. I guess just lastly on loans, there's something called intercompany loans, isn't there? And I guess this is something for if you were self-employed and you were set up as a limited company, and let's say you had a reasonable, decent profit each year, or there was retained profits within the business. There are some lenders who will consider essentially a deposit from what's called an intercompany loan. So you've got a limited company over here. Let's say it's 100,000 retained profits. You've got your buy-to-let limited company over here, SPV again. And there's a way of essentially transferring the retained profits from one business to the other via an intercompany loan, versus taking the money physically out, paying, dividend tax potentially at, whatever the rates are, depending on your bracket, and then using the money then to invest in the limited company. There's a way of kind of essentially loaning that money across. Could you just touch a little bit on how that works?
So let's say, for example, you've got a successful trading company and you're already taking whatever you need to live, obviously, but let's say £100,000 a year for ease, so you're already paying quite a significant amount of personal tax. But you've still got some surplus cash in the business, and you decide property is the way you want to go. Now you can loan the money directly from trading company A to SPV B over there or whatever, and it's a loan between the two companies. Now that way you haven't had to take the money out personally, so you have to take it out personally, you pay personal tax on it to then effectively potentially just put it back into another limited company or SPV. So it's a way of basically investing those retained profits without having to take the money out of the company at that point. So, and then the money sits as being owed. So the property company will owe the trading company the deposit or the loan up until obviously it's repaid, or whatever happens down the line. But so it's a very good way of basically utilising reserves that you don't need in your trading company as such to invest it in property or investing it in property in the SPV.
Right. Okay. Yeah. Very interesting. And that's something definitely, if you've got a limited company with those, as you say, earnings which are available, which have already had their tax paid on, then there's an angle there.
That's so much is that the trading company's already paid the corporation tax on it. But it's just, as you say, it's a way of, if you, for example, you were going to go down the SPV route to buy property rather than you take the money out personally to pay high personal tax on it to then put it back into a limited company, makes much more sense just to do a straight loan between the two entities.
Yeah, definitely. And there are lots of lenders who can consider that. I mean, again, it's a specialist area of lending. Not all lenders do that. But there's definitely lenders who can consider it. So certainly an option. And I think that's becoming more and more prevalent nowadays, especially with the tax implications with, as you say, taking the profit out and moving it across. Okay, Darren. Well, thank you very much for those questions today. Really appreciate your time, and we'll speak to you soon.
Okay, thank you, Paul.
Thanks for watching. And if you have any questions, please ask below and hit subscribe below so you don't miss out on our next episode.